Here's something most investors don't realize. It's not just what you own that matters, it's where you own it. It's a super common problem where we'll all review a portfolio for a successful business owner or an executive who's doing everything right. Diversified investments, solid returns, regular rebalancing, yet he was unnecessarily giving away tens of thousands of dollars every single year to the IRS. Not because he wasn't paying attention to taxes, but because he wasn't paying attention to where his assets were located. That's exactly why in today's video, I'm going to show you how to implement a tax-aware asset allocation framework that could potentially save you thousands or even tens of thousands of dollars in taxes every year. This isn't about picking better investments or timing the market. We're strategically placing your investments in the right types of accounts to minimize your tax burden and maximize your after-tax returns, which is the only return that matters. Once you understand this framework, you can start implementing it immediately, whether you manage your own investments or working with an advisor. So let's get to it. Number one, you have to understand your three basic tax buckets. There are three different account types with very different tax treatments. First, we'll call them your taxable accounts. This is something like a regular brokerage account, an individual account, a joint account, or even a trust account. There's also the tax-deferred accounts, something like a 401k or a traditional IRA. And then there's your tax-free accounts, the Roth IRA, the Roth 401k. So here's what most people miss. The same investment performs completely differently in each bucket. But how could that be? And why does it matter so much? Well, we're going to get into that on the asset location strategy. So we'll start with your taxable accounts. What performs best here in those brokerage accounts, the individual or joint accounts? Well, things that are tax efficient from a capital gain standpoint. Think individual stocks, ETFs, individual bonds, particularly of the municipal style if you're of a certain level of income. Why? Because you're paying taxes on these every single year. When you sell them or any income that's produced, you're going to want to make sure that these investments are tax efficient or at least provide control for you on when you realize the taxes. Next, let's talk about your tax deferred accounts. What's best in here? Well, oftentimes things like individual bonds of the taxable variety, real estate investment trusts, mutual funds, especially ones with high turnover rates, or individual stock models that will generally have short-term gains that are generated. Any of these investments that generate ordinary income or short-term gains or distribute capital gains without any control for you, those are where you want to just house those in the tax shelter of an IRA, 401k, a 403b. Those are excellent investments to put into the tax later bucket. So what about the tax-free, the Roth accounts, the dollars you pay tax up front and then never pay tax again? What should go in there? Ooh, this is where you really put the pedal down. This is your growth engine. These are the investments that you want to target, the greatest risk that you can stomach, and don't worry about the tax situation in there. So this is where you'd want to put your high-flying growth name stocks. Maybe it's your small cap stocks or your emerging markets where you think you might be able to get larger returns, or maybe it's the big tech stocks that have been dominating things recently. This would be your highest conviction, highest risk, greatest possible return over the long term type of investments. And again, this is tax shelter, but you're trying to maximize the growth on this account at all costs. These are tax-free forever after the initial tax bite on the front end. Now, before we get into the implementation steps, I need to mention something important. While this framework is powerful, implementing it requires careful coordination with your overall financial plan, including your income needs, your risk tolerance, and your estate planning goals. At John Moore Associates, we don't just implement tax-aware asset allocation in isolation. We integrate it with comprehensive tax planning, charitable giving strategies, and biblically responsible investing to create a cohesive strategy that aligns with both your financial goals and your personal values. If you have over $500,000 to invest and want to explore this framework and how it could reduce your tax burden while honoring your faith, visit johnmoore.com to learn more about our process. Now let me walk you through a real-world hypothetical example. Consider a couple with a $1 million portfolio. They have $400,000 in their taxable brokerage account. They have $400,000 in their traditional IRA, and they have $400,000 in their Roth IRA. So how do most people do this? That's the exact wrong way. They distribute everything equally everywhere. They pick their asset allocation based on their risk tolerance, and they do it all the same everywhere. They say, I'm a risk tolerant investor. I want 70% stocks. So they put 70% stocks in all three of their account types. What this is doing is it's wasting the tax-free growth potential in their Roth. It could be getting a tax drag in their taxable account, and they're not getting their income producing assets, their safer assets in their IRA. So what's the right way to do this? Yes, asset allocation is very important. Maybe they want 70% overall in stocks. That is their target stock allocation. So what would they put into their Roth IRA? Most of the stocks. They would probably want their Roth IRA 100% stocks. Individual stocks, small cap, growth, it doesn't matter. Put those in the Roth IRA for the long-term growth. Where should they house their bonds or their mutual funds that distribute capital gains? Those would be great in their IRA because those are less tax efficient investments. So why not house those in the tax deferred vehicle where they're not trying to max out growth like the Roth, but they still need the tax deferral? So what are they going to put in their taxable brokerage account? Well, they should put ETFs, broadly diversified. Maybe this is more in alignment with their overall 70% portfolio. But if you look at the portfolio as a whole, this mix would still be 70% stock, call it 20% bond and 10% alternative, but you're putting the right investments in the right places. That asset location can dramatically increase the after-tax return, because ultimately it's not about your total return, it's about your after-tax return. After tax is the only thing that matters, because those are the only dollars that you can spend in retirement or at other phases of life. Just putting these assets in the right place at the right time could equate to thousands of dollars difference on an annual basis. So over the course of 30 years, that could be hundreds of thousands of dollars of tax savings. So now let's talk about implementation steps. Where do we even start with this? Well, first, you have to know what you have. Take an inventory of every account, every balance, every investment that you have, the capital gain or loss on that investment, how much income it produces, the tax treatment for each one of those investments. Understand what you have and where you have it. Then you need to determine what is your target allocation that you're striving for and how does that fit into your overall plan? Are you taking the appropriate amount of risk for the time frame that you have in place? Now, this is an important one. Don't let the tax tail wag the investment dog. Don't just make investment decisions based on the tax treatment. Make sure that you're making investment decisions with taxes in mind and not the other way around. So once you have that inventory, you know what you have, where you have it, what the tax treatment is of both the gain and the income. Now you can start with strategic placements. Some of these investments can be moved from one account type to the other. Others would have to be sold before the cash could be moved. So what you'd like to do is you'd like to start with the most tax inefficient investments and make sure those get into a tax deferred vehicle. You want to make sure that you get the most tax efficient investments that we listed earlier, things like stocks, individual stocks, ETFs, municipal bonds. These investments should find their way into your taxable brokerage account. And then any of that risk, the long-term growth potential, the stocks, the things that you feel high conviction about, those investments should find their way into your Roth IRA. You don't need a balanced portfolio in each one of these accounts. You need a balanced portfolio over all the accounts, whereas each account plays their role in the overall plan. Now, this is really easy to do in those tax-deferred vehicles. In the IRA or the Roth IRA, it's really easy to sell because the capital gains don't matter and buy the investments that you want in those accounts. But the taxable brokerage account, you have to be really careful on. There's considerations here where you have to look at each one of the tax lots for each of the individual investments. They could have been purchased at different times, and you want to make sure that you understand what the tax liability is for selling and exiting each one of those positions. Have they been held for more than a year or less than a year? Is it worth selling now, or should we wait and take the risk and sell it once it goes long term after we've held it a year? What is your rebalance strategy each year, particularly in the taxable accounts? This is highly important because this can be a shock when you get your tax bill in April, when you realize just how much tax you incurred just for the sake of rebalancing and readjusting the asset location in your accounts. So there's some common mistakes that I see people make all the time. I've already mentioned one of them, and it's letting the tax tail wag the investment dog. Don't do that. This is investing with an eye to taxes and not the other way around. It's also something where they'll target target too much, they'll overfund their IRAs, they'll get too much growth in their IRAs, and as our founder John Moore would say, they reach a square corner. He was a pilot. It's a square corner where RMDs start, required minimum distributions start, and when those IRAs are too big, it creates a tax bomb in the future. They also might forget the state tax considerations on the income that they're going to be producing, especially those folks in retirement. There can be taxability to your Social Security and other benefits that you need to be aware of before you start churning out income on your accounts from these different tax buckets. You also need to keep an eye on your current tax bracket versus where you think your future tax bracket will be. Not every bucket should be filled up the same way every year. That is year to year dependent on your income and therefore your tax bracket. And be careful about over-analyzing this. This is an easy thing to get stuck in the weeds and get analysis paralysis, wait for that perfect plan, instead of just taking some small steps to make marginal incremental improvements over time. So here's the bottom line. Implementing a tax-aware asset allocation framework isn't just some fancy strategy for the ultra-wealthy. If you have investments spread across different account types, this applies to you too. And the sooner you implement it, the more you'll potentially save in taxes. The difference between doing this right and ignoring it could potentially be hundreds of thousands of dollars over your investing lifetime. That's money that could go towards your family, your giving, or kingdom impact instead of unnecessarily going to Washington and the IRS. At John Moore Associates, we implement this strategy as part of our comprehensive planning for every single client. We look at your entire financial picture, your current tax situation, your estate plan, your charitable goals, and create a coordinated strategy that maximizes your after-tax wealth. If you're ready to stop leaving money on the table and want help implementing this framework as part of your comprehensive financial plan, please visit johnmoore.com or click the link in the description below to schedule a consultation. And remember, being a wise steward isn't just about making good returns, it's about keeping more of what God has entrusted to you so you can use it for His purposes. Thanks so much for watching. If you found this valuable, subscribe to our channel for more advanced strategies to optimize your finances.